Hi, I'm Frank Notaf, Chief Economist at Freddie Mac. Interest rates on 30-year fixed-rate mortgages have risen by half a percentage point since the beginning of May, and it's natural to wonder, what's the impact of higher interest rates? Will it choke off the nascent housing recovery? And indeed, to be sure, low interest rates have helped to fuel the housing recovery, with home sales and house prices up over the past year. By our analysis, though, housing remains broadly affordable in most parts of the country, and we believe mortgage rates would have to rise to almost 7% before housing becomes unaffordable throughout the U.S. for families with median family income. To be sure, this varies a great deal by market, and in high-cost markets, housing may already be unaffordable for a family with median income. And the highest cost markets that we see in the country are along the California coast from San Francisco south to San Diego, and along the northeast coast from Washington, D.C. north to Boston. But for much of the rest of the country, housing remains extremely affordable even with the rise in mortgage rates. Now there's one plus to home sales from the rise in mortgage rates, and that is we may see first-time home buyers that may have been reluctant to come into the market now start to come in. Those potential first-time home buyers who have the financial capacity to buy and were waiting for the market to bottom out have seen that mortgage rates have started to move up and are expected to move even higher, and they may come into the marketplace now, helping to bolster home sales in the near term. Now, in contrast to the home purchase market, the refinance volume is affected quickly and sharply whenever mortgage rates rise, and we expect refinance volume to be down significantly in the second half of this year compared to the first half and compared to 2012. In fact, for the year as a whole, we expect refinance originations to be down by 1/3 from 2012. Now, to put everything in context, even though we've had this rise in interest rates with 30-year fixed-rate mortgage rates up half a point since the beginning of May, it's important to keep things in historical perspective. Mortgage rates today are still extraordinarily low. They're still well below where they were prior to the recession. And that will help to maintain affordability for housing in most parts of the U.S. And that's why we expect any negative effect on the housing recovery to be relatively minor, and that the housing recovery will continue over the course of the coming year. Thanks for your time. Look forward to seeing you next month.